Hello, everyone, and thank you so much for joining our apartment investor forum today. My name is Brandon Lawler. I work on the Simon Anderson multifamily team here at Kidder Mathews in Seattle. Our team, we specialize in apartment sales. We've closed 36 apartment transactions this year, and we do focus all around Washington State. Just some background on myself. When I was 10 years old, growing up here in Seattle, I actually wanted to be a orca whale trainer. Thought that was going to be the best job in the world. And now I do something slightly different. But after working with Dylan and Jared and our team for the past 3 years, I've definitely changed my mind about that. And once again, really thank you guys for joining. I'm very excited to be here as I personally remain focused in the South Puget Sound market. I know you guys are all professionals trying to get ahead of the market. I really respect and appreciate you all being here today. And I've spoken with many of you and really looking forward to building those relationships moving forward. Goal of this webinar is to share with you the insights of what we are seeing today in the South Puget Sound apartment market, talk a little bit about operations, and then what we're seeing for the future and what we are predicting for the future. We have a very esteemed panel that is joining us today, as you can see, and I'm very excited to introduce our panelists today. I'll give them a minute to introduce themselves, their company, and then their connection with the South Puget Sound apartment market. We'll want to start off with Kathy Dobler. When I joined brokerage around 3 years ago, I probably left around 20 messages with her assistant before I ever reached her. So her time is very precious, and you should all be very appreciative that she is here today. But Kathy, I'll let you introduce yourself.
Well, thank you, Brandon, and thank you, Kidder Mathews, for the opportunity for this seminar today. My name is Katherine Dobler. I'm with Dobler Management Company, and I have been the broker and started the firm back in 1986. I now have approximately 40 years in real estate, and 39 of that is in multifamily. Have the benefit of growing up in a family that had real estate, and then my two sisters are involved in the business with me. So we are probably, I'm pretty sure, the only real estate management firm that's women-owned. With that, we do kind of have a little side on viewing things a little differently because of that. One of it is we're very well known for our properties that we literally look at the sites as if though we were going to live there ourselves. And what would happen if, for example, if I made $25,000 a year, what would I need at this property? What would I want at this property? And what will this property get for me for my best dollars? And with that comes into a lot of kind of thought processes of where our residents need things, like if there's night workers, if there's families where the children need different activities for play. Our schools are really important for us, and we are extremely well known for value added. So coming into the business in between 83 and 86, the tax laws were beneficial to actually lose money in the multifamily business. So when we opened in 86, we immediately had to change that philosophy to go to either breaking even or profit. So we were called, and we kind of flew under the radar, taking on 60 to usually around 20 to 60 unit sites. And so we weren't in competition with the larger developers and investors. So cut our teeth on that. We do have a lot of continuity. We decided to stay in Pierce County and make that our predominant market and not venture too far out of that. One of the things that is a little different is we do team manage, because we did find that we had strengths in different areas. So for example, we have asset managers that are stronger in lease up. We have asset managers that are more renovation based. And we have asset managers that are more legal based. So we all work together to solve problems, which is nice. It kind of gives us a fresh attitude, lots and lots of boot time in the field. So business wise, I don't think Pierce County has ever seen the occupancy rates that we have today. And I look forward to hearing what the other folks have to talk about, and also questions.
Absolutely. Well, Kathy, we're looking forward to it as well. And thank you very much for that introduction. Next, I want to pass it to Beau Madsen. Since Beau joined Rise Properties Trust back in 2018, He has helped acquire well over $1 billion worth of real estate here in Puget Sound alone. So he's very active. We're excited to have him on. Beau, I'll let you take the floor.
Thank you, Brandon. It's great to be here talking about some of my favorite topics, South Puget Sound. I'm proud to be a native of the South Puget Sound. I guess I never really had a good reason to leave. So I went to the University of Washington and have been investing in apartments ever since, locally and across the country, but lately more locally. I'm fortunate to have found my way to 𝐸 Properties Trust, which is an owner-operator of multifamily, very specifically multifamily, based in Seattle. We own about 6,000 units now between Seattle and Portland. And as you mentioned, a vast majority of that has been acquired over the last 3 or 4 years. Been definitely a busy time for us. We have an affiliated property management firm, Thrive Communities. And they manage another 10,000 units or so throughout the Puget Sound. And they've been doing about $130 to $150 million of our renovation work for us, and it's still ongoing. 𝐸 will buy assets wholly owned for our REIT vehicle, and we'll also partner with a variety of institutional capital. So we have a pretty good pulse on what how other capital is thinking beyond just ourselves. And I think, property management is a challenging business, and I think we strive to do things a little bit differently. And I'd probably sum it up by just saying that we are very diligent in our efforts to create a sense of community. A lot of the things that Kathy was mentioning, I think a lot of professionals take their job very seriously and understand the importance of housing and what this means for the people at the sites. We really want to create a sense of community for them. Looking forward to the panel and excited to be here.
Thank you, Beau. Very much appreciate that as well. And then last but not least, would love to introduce Brian O'Connor. When I told my partner, Dylan Simon, that I was going to take over our team's panel for the winter, the very first name he recommended was Brian. Maybe because he owed him a favor, or maybe because Brian is just that good at research and knowledge, and his experience is that important for this panel. So I know it is the latter, but Brian, I'll give you the floor.
Yeah, hello. Yes, I'm Brian O'Connor. I got into the business here in about '85, came in as an appraiser, and just sort of happened to fall into doing a lot of multifamily at that time, because there was a big multifamily market in the late '80s, right? It was the other apartment boom. The last big apartment boom was in the late '80s. And what happened, I started doing a lot of market study work, and I found that kind of more interesting than appraisals. It's more macro than it is micro. And so I've been doing apartment market study here in the Seattle-Tacoma metro area. I've been doing a macro study every 6 months for 35 years. So got lots of data, love data. Us guys, we just love data, right? So, and of course, then I worked for somebody else for a while, and then I expanded, had my own firm. I started that in '94. And my firm is a little different than most appraisal firms. About half of what we do is appraisals. And it's just like what you think, bank work, lending, attorneys, legal work, that kind of stuff. But the other half is really, it's market and feasibility studies. So I end up helping investors figure out if they're looking at a new deal. Usually it's with new construction or it's a rehab opportunity. And we kind of get in, we figure out the numbers. Where's the upside? Where's this going to go? We look at the macro part of the market. We're very big on supply and demand. I mean, you can't get away from that. If you want to know where the market is headed, you got to look at the supply and demand. And so we've been doing that for a long time. So we'll do about half our work will be a market, projecting out what the market's going to be, looking at the new product and estimating what is the market going to look like when this building opens its doors, and how is it going to perform, right? So we do a lot of that. So, and I got some new numbers for down south too. So I think you hot off the press kind of numbers. So, and
Nice.
they're outstanding numbers too, by the way.
Nice. Love to hear that, and thank you for the introduction, Brian. I'm sure we will definitely jump into some of those numbers. Would love to get started on our topics, starting on just acquisition appetite. I'll put this question to you first, Beau. Looking at the South Puget Sound, where are you currently looking, and what locations are exciting for you guys right now in the apartment market?
Yeah. So Rise is only in 2 markets, so Seattle Metro and Portland Metro. So it's hard for us to cross out any specific locations.
Yeah.
But as a general philosophy, we believe most deals have a price that can make sense. So we do try to cast a wide net across the Puget Sound and are always looking for a good value where we can find it. And so that means we're able to look in urban Seattle to suburban Portland and try to find those best opportunities. And fortunately for us, I think there's not a one size fits all on location and how that balances with price. I think collectively what we hear from our capital partners, and I think locally here as well, most people are most excited about what's happening on the east side specifically, in terms of the light rail going over there, quality of life that they have, public schools, and the long-term prospects of Bellevue. But I think that'll definitely, as Seattle and Bellevue grows, that expands to the Puget Sound, and as the South Puget Sound is a big beneficiary of that.
Mm-hmm. Yeah, absolutely. I know the east side has been very popular, and so has Pierce County as of late. Kathy, you have a lot of experience in Pierce County. What locations are you excited for right now in the investment market down there?
Well, it's definitely tough to find properties. There's no doubt about that. So what we do prefer, well, 2 things we've done. One is we've gone into and acquired land. So we are doing land acquisitions because we can build for less than what it would cost to buy. And then the second thing is, I think we're back into flying under the radar. We are looking for what we would call our boutique properties, which are smaller that the larger investment pool won't be looking at. And then we can swing in and look at those. It does vary on age and size still, though, as far as the properties. But it's a one kind of, they always show up when you least expect it. And if you don't really want the property, you actually will get the property. It just seems like that's the way it works, which is kind of comical. But I do think that with the interest rate changes and some of the, we'll see some more stuff start to pop. Tax regulations, and then just government regulations. We will see more things come on the line.
Mm-hmm.
So,
yeah. And Brian, a little bit of a different question for you. Where are you seeing most activity on your end right now in the Puget Sound?
Wow. Oh, between the Canadian border and Olympia. It's everywhere, right?
Yeah.
Really. Let me say something about Pierce County. Pierce County might really kind of be finding its own right now. Last year during 2020, if you looked at the demand numbers for the county, typical, like I said, I go back years. Pierce County usually absorbs net demand 500 to 700 units a year. 2020 did over 3,000. It was just like, you just shook your head like, what's going on, right? And I thought, well, maybe it's everybody's moved out of Seattle, right, and went to Pierce County. Then following it this year, Seattle, it's like they came back, the vacancies went down, but Pierce County still seems to be right in there. So what I'm wondering is if something's changed, maybe on the investor side, buying property in Pierce and Thurston used to be more about cash flow than appreciation. And in Seattle, it was more about appreciation than cash flow. And I'm wondering if that's changing or not, that if Pierce County now is starting to see more yield coming from appreciation than just coming from cash flow. And I think if that happens, you'll see a lot more buyers wanting to be in Pierce County.
Beau, it looks like you were nodding your head yes to that.
Oh yeah, I think from the institutional capital world, when I first started 10 years ago, Tacoma, you can never capitalize a deal there. You'd have to run through 30 investors to find one that was thinking about it. And today we have partners calling us, asking us to find them, deals in Tacoma. So yields are not, there's not a wide discrepancy to be in Lakewood or, the north end of Tacoma versus, it's very comparable to Linwood. There's very negligible discount on yield for comparing to anywhere in Tacoma versus anywhere in South King County. Kent and Tacoma, I think, are, from what we see, valued very, very similarly on a yield perspective.
Yeah. And I guess we can keep it on you, Beau, but then we'll have to pass this question over to Kathy and Brian as well. What factors do you think are driving these investment decisions into Pierce County and into South Sound? Is it the high occupancy or the rising rental rates year over year, or what do you think are the biggest drivers?
Yeah, so it's hard to break out Pierce County's, we're part of a bigger pie here.
Yeah.
And honestly, it's hard to conceptualize a market with better apartment fundamentals than the entirety of Puget Sound. Has a large and booming industrial sector, strong outlook in life science and tech, paving the way for the future, and very, very real supply constraints for housing. So it just creates a really good, fundamentally good market throughout the Puget Sound. So I think Tacoma is a beneficiary. I think the whole Puget Sound is a beneficiary of that. That pie. Yeah, absolutely. And looking at current sales trends, we're seeing the highest sales metrics per unit per square foot in South Sound. We're seeing an average cap rate for the first time in that 4% range, even for properties 5 to 50 units in Pierce County. Kathy, you've been in this market for a long time. Why do you think that is?
Well, it's definitely the ability to raise rents, and that's always the sticky wicket, because we can easily get 150 to 200 more per unit on a turn than the existing resident base. So we always have to have that kind of fine line, because you have quality residents that we want to keep, but at the same time, we have to make sure that we can cover this cost effectively. And so what typically on a turn is where we're finding that larger spread in order to take advantage of that. We kind of have to do it anyway because of the property taxes are rising so rapidly, and our operating costs are continuing to rise. So rent increases are strong. There's still a lot of potential on those. It's not what residents want to hear, but we do have to, definitely weigh those as we're going through the process. And having just been opened up to do rent increases recently, there was a lot of need to do that. But also it is hard to build. And if you're trying to put up a project, cash is king. You got to have a lot of money, and people don't realize how much it takes to pop a building up. And then you have to have a lender that is willing to produce the loan that we need to put the projects up. So that's a whole nother side. Housing costs, the more they rise as far as single family, the more we have folks staying in the apartment business. So that helps us too.
Yeah, absolutely. And Brian, I know you're obviously a big numbers guy. Hearing that average cap rate, right around the mid 4s in Pierce County. Why do you think that is?
Because they can borrow at 3, you know,
Yeah.
and it's got a good story. But when I'm looking at Pierce County and even the south end of King, it's a lot like Kitsap County too. In fact, sometimes when we work in Kitsap, there's not enough apartment sales there. We'll use something from Tacoma.
Yeah.
And lenders accept that. Everybody accepts it. It's the next best place. But if I think we're talking about rent increases, because I think that's probably the most important issue. That and construction costs. Rent increases and construction costs are probably the two big ones. What we're saying, since we're doing studies, we just finished studies up in Bellingham, Skagit, Snohomish, Kitsap, all over, right? And I'm seeing the same thing. I'm seeing everywhere we go, the vacancy rate is 3% or less. And in some places it's 1. Bellingham area, Whatcom County, vacancy is 1%. You go to Skagit, this is no joke. We did a study there. We couldn't find a vacant unit. And we surveyed like 1,200 of the best. Seattle's around 2.8. The east side's about 2.9. Tacoma, the city of Tacoma is about 2.5. Pierce County overall is about 2.3. You go to Thurston as of September, Thurston's about 1%. This is the story. Kitsap's about 1.7. Everywhere we go, this is the story. So whenever you see, if you look back in history, and whenever you see vacancy rates this low, we can correlate what the rent increases are likely to be. I mean, it's a pretty tight relationship. You know, I mean, it's intuitive, right? If vacancies were 5 or 6, you're not going to get a very strong rent increase. If they're 1 to 2, you're going to get a strong rent increase. And if we're sitting at 2, 2.5, that would tell me you're probably looking at rent increases 5 to 6%. In markets that get down to 1 and 2%, frankly, it could be as much as 8% if the management and the owners want to do that. Some of them don't want to do that. So I'm very optimistic about Pierce County. The issue with new construction, though, is we're kind of caught the cost increases got out in front of the rent increases in most markets. So the cost, probably because of the whole COVID economy, pushed the cost up, but the rent growth was lagging a little bit and it has to kind of catch up. So last year and into early this year, it is hard to make anything pencil, especially in Seattle or the east side. Even the east side is as good as stories it's gotten. Very difficult to make it pencil because of cost. I had a lot of clients chasing woody walk-up dirt. Everybody, when they saw the problems with cost, everybody wanted to go to woody walk-up. I never seen Puyallup get so popular. You know, look at Marysville and Puyallup. I mean, it was like, you know, because those numbers work, right? Those numbers work. So we have to get those rents have to climb up to be able to offset some of these costs. And I think that's what we're watching very closely to see how much rent growth and where we can start to get these deals to pencil out a little bit better.
Yeah, absolutely. And Beau, I know you have more of an institutional level look at a lot of these properties. I think lately we've seen pricing really boom in South Puget Sound. Do you expect pricing to continue to rise, or do you see pricing leveling out a bit as, you know, maybe investors and tenants do start coming back more into core Seattle?
Yeah, I think there's a lot of variables, obviously.
Yeah.
I think Tacoma has been unique in that, you know, all of Pierce County has been unique in that the discount on yield that investors expect has essentially been eliminated. So you're valuing it as if it were Kent or Renton or Linwood. You know, it's all very, very similar on a cap rate basis. What's also, I think, unique that I think a lot of people are interested in, I would think, is I think investors are still trying to get to that 4.5, yield after all is said and done. It's not always 4.5, obviously, and it ranges. Usually has a 4 handle of where people are trying to take a property. And what's been very challenging for investors lately is that huge gap that we've been talking about on the rent side. So you've had the moratorium that has prohibited renewal increases. So anybody that's been in the apartment community since 2019 is at 2019 rents, and they've been renewing. Everybody coming in is paying $300 more than whoever lived in that unit last, because that resident left for some reason.
Mm-hmm.
So you have this really big loss to lease that makes your trailing cap rates really low. And I think that's what's been everybody's been shocked consistently over the last year. You're buying a 3 cap. It's not easy to buy a 3 cap, but you need to have the vision to take it to something with a 4. So I don't think that's changed very much. It's still compressed, with capital markets. So in terms of leveling out, I think appreciation between rents and compressing yields is going to continue pretty aggressively in 2022. And I think there's the 2 strong factors that we're able to forecast a bit. I think in-place rents, I think as Kathy and Brian had talked about, are much lower, and those will trend closer to market over the next 12 months. And that's going to make financing a lot easier as your trailing caps improve. Over the last year, everybody's been buying trailing yields in the 3s, in a lot of cases. So that's been making financing hard, and I think that challenge is going to get easier as the rent roll kind of matures. But I think deal flow is going to be strong, but slower than this year. We still have all the capital out there that's chasing these deals.
Mm-hmm.
So you're going to have a good year of flow, I think, but it's not going to be what this year was. And then on the other hand, the capital chasing is only ramping up. We've seen no leveling out, no slowing. The allocation changes to apartments has been very significant. And a lot of our partners have very, very large multifamily allocations that they need to deploy over the coming years. And so many deals have sold in 2021 that anybody that was thinking about selling sold this year. Didn't have to worry about the vision to get to the 4.5. So you're going to have lower deal flow next year, but just as much, if not more, capital chasing it.
Mm-hmm. Okay. Well, Beau, I do really appreciate that insight. Passing it over to Kathy, Beau looked into his crystal ball and thinking just as much competitiveness, but maybe a bit, slower of deal flow. Kathy, what do you think as far as, that trend in Pierce County?
So for Pierce County, I think what will drive the values is going to continue to be that cost of construction. And then we look back at the existing projects, and where we'll see the most difficulty is rising costs. I knew, looking at numbers, that inflation was there. Everyone kind of hid that under the rug for quite a while, but it was really brewing around May and June of this year. And so I was a little surprised. I was pretty sure it was around 5%, but I was surprised when it came out at 6.2. So what is difficult is these rising costs. And of course, I'm a numbers person, so I've been grinding numbers and looking at the expenses. And for example, payroll is a rising cost. It's very difficult. It's hard to staff, really hard to staff right now. It's also difficult for the trades. And so we're finding that between the labor and then the supplies that we need, that is a crunch. And we literally had to search all over for chlorine just to keep the pools open this year, which was a kind of a juggling joke. But if one site had chlorine left, we were like, can we buy, chlorine to send over to this site? Because the vendors were great. Our suppliers are great about stocking for us, but they themselves were limited. So a lot of supply chain issues come into play. As those hit our books more, we will also have a little difficulty in that NOI, which of course will change valuation. I think we've seen the glory days almost, if I want to say it, for 2021, 2022 should be pretty good starting out. But then as all these things start to continue to eat up NOI, then I think we'll start to settle down.
Mhm. Yeah. Or Brian, it sounded like, looks like you had a comment there.
Well, yeah, I think you can anticipate costs will probably start to settle down. I'm starting to see it a little bit. We just had an assignment where it was really about cost. So I talked to a lot of the cost people that are behind the curtain, a lot of these big development companies. And it wasn't as bad as I thought. I mean, it's higher, but it wasn't bad as I thought. But the other thing that I don't think people are tuned into is, I mean, if we look at how many units are under supply or are under construction relative to our demand number, and we're undersupplied. And when we do our forecast, we look out with a high degree of confidence about 2 years, because that's based on things that are actually under construction. Beyond 2 years, then you're estimating, well, who's going to start construction? And then it gets real iffy. But we did a little exercise here at 𝐏𝐻𝐿. I didn't do it for Pierce yet, but we looked at the first 6 months of this year, and we said, how many units actually started construction in 6 months? Now, normally 5,000 to 6,000 units would have started construction. This year, 850. I thought something was wrong with our numbers. I mean, it was like we went back and double checked all that, and I realized, yeah, it was these deals that people were trying to get loans for last fall, this time of year, that would start in the spring, and nothing was working, right? Because of the whole COVID economy thing. So it just pushed off that supply. So I'm looking out going, we just did one down in Puyallup, and we looked at the market. Based on 2 years of supply and demand, vacancies are going to be going lower. We're undersupplied. And then off my radar screen, you might say, off the end of my time period, I already know we haven't had the starts, the normal number of starts that we typically have. So what's going to happen is we're undersupplied now, and then 2 years from now, when we would have had new product coming online, we're not going to have it, and we're going to be undersupplied for another year. So I bet we're going to be undersupplied for 22, 23, and 24.
Mm-hmm.
And it's just going to take that long for the machine to kind of catch up and get the starts going and get the cost stabilized and rents up and the whole economics of it back again before they can really bring on a lot of supply.
Mm-hmm.
They'll have starts. There'll be a few starts here and there, but it just won't be the volume that we normally have had.
Mm-hmm. Yeah, absolutely. And I do want to pass it back to Kathy, and looking more on, current day-to-day operations at buildings that you own and manage, like Brian is talking about, like we have been hearing in the market, just phenomenal occupancy levels. Seems like everything's pretty perfect, but do you want to see, how are things on a day-to-day level for your operations? And is delinquency still a big factor for your property management company like we saw, back in 2020 and the start of 2021?
So as far as delinquencies goes, because I know that is a topic a lot of folks want to know about.
Mm-hmm.
Without a doubt, every time the moratorium was extended, the delinquencies rose. Predominantly because there's a group of a population that are kind of capitalizing on that ability to not pay rent. Initially with COVID, there's a different viewpoint on the resident side. That's like, keep my house, how do I keep my roof over my head? And a lot of folks were actually like prepaying their rent to make sure, because they weren't sure about their job. They've been furloughed, or the restaurant or wherever they worked was closed. So there was more caution. And it's funny because Pierce County is a very strong workforce housing and workforce people. We have a lot of blue collar, a lot of service. When you grow up and you've been in the trades or you've been in the service industry and you've grown up with a business in that nature, you're generally a worker and you've been a worker all your life. And so when things got furloughed or when things got closed down, those are the folks, if they lose their job, they get up the next morning, they go get another job. They don't wait for someone to say, oh, by the way, because of COVID, you don't have to pay rent. So it was interesting to watch, and it's still interesting to watch the demographics of the folks that haven't paid. There's a definite correlation of who doesn't pay versus who does pay. So fortunately in Pierce County, we've got a really, really good nonprofit groups, and we've worked with them from day one. We've got nonprofits that have been in business for 40 years to help folks. And so they were geared up quite quickly for the COVID relief. And without a doubt, our single parents had the worst time for the COVID cycle because they needed the schools to be open. And when the schools weren't open, they were constricted on their jobs and their ability to go out and work. Schools being open has been very, very helpful, but it's still a struggle because sometimes, like we saw in King County, what was it, last Friday, they literally closed all the schools. So that's extremely difficult for working folks. But in that context, I think with the delinquency rates, we've had very good success. We do keep in close contact. What folks don't understand is the ones that don't contact us back, I mean, that is one big nightmare coming their way. I mean, that snowball is rolling down the hill behind them. And unfortunately, I think they hear just enough of the news to think that that's okay, that they can, ride this COVID deal, but that the train's stopped. And it's coming right back at them. So on those, we hope that they kind of start communicating. I have sites that are 100% collected. I've got a lot of sites 100% collected, but I do find that there is a demographic that is waiting to see if there might be some other thing coming their direction. Unfortunately, that same demographic spent their money on consumer goods rather than, what things they probably should have, like utilities and rent. But again, that's something that they're going to unfortunately learn kind of the hard way. But overall, very appreciative of our residents that pay. We're very appreciative of all the things that they've done in order to make sure that the properties could still function. That's important to us.
Yeah, absolutely. And Beau, I know you're more focused on the acquisition side, but how have day-to-day operations, rent and vacancy looked for you guys these past few months?
Yeah. So I would say on the delinquency front, by month end throughout the pandemic, big picture, I'd say we've collected pretty like average numbers at around 90% by the end of the month. It's been very consistent. And then maybe another 2 to 3% will pay late. So you're maybe operating at like a 7 to 8% delinquency rate. And although the goalposts have changed a lot over the months with the various counties' assistance, and they've done a Herculean effort to create these programs locally and try to figure out how to get that assistance out. And despite it being pretty challenging for our whole portfolio, we've been collecting about 80% of our losses through those assistance programs. And we're thinking by the end of 2021, we'll probably have a net delinquency around 2%. So it's challenging, especially during the throes of it when we weren't able to really communicate with residents if they weren't coming to us. But we had a property specifically that had 15 people as of last month that were just not communicating with us and were racking up these huge balances. 14 of them came to us this month of the 15 and started trying to work out payment plans. So that's not true for every site, but I think it goes to Kathy's point that there's this, there's a portion on each set on most properties that have been trying to make their way in the best way that they, felt like they could. Mm-hmm. On the rent side, that's kind of been the offset to all, what would have been a very, gloomy delinquency story over the last year and a half. It's been offset a bit by rents that have moved materially, and that usually makes everybody's jobs a little bit easier on the investment side when that's happening.
Yeah, absolutely. Well, I know we've talked quite a bit about 2021 and what's going on right now in day-to-day operations. You want to jump a bit to predictions for 2022, since it is right around the corner. I'll kind of float this question out to whoever wants to take it, but what do you expect to change in the investment market in the next 12 months in 2022?
I'll make one point. I do think that the last year and a half has been an exit for a lot of the smaller property owners, and I truly do not think they will come back in the market. And that's all over the Puget Sound region. Many have left the state, and if they exchanged out, they've gone to states inland. They have found, they're getting away from the regulations. They're getting away from kind of the shutdown of the state and going into other states where they can operate. And I think that will, coming back in, I don't think we'll see them back. It's very, very difficult to be a smaller investor in this marketplace as it is, because the cost is to purchase is so much more. But I think now it's going to be left to the larger locals and the large institutional buyers at this time, which is unfortunate because they definitely fill a niche that we do need. I just don't think they can financially come back in.
Mm-hmm.
Operating apartments and investing in them, I feel, is ever increasingly becoming more sophisticated. That benefits larger institutions. They're able to staff for that.
Mm-hmm.
I don't see a lot, I think over the last 18 months, there's been a paradigm shift for the whole world, obviously, but also for where people are renting and what apartments they want to rent, where and what type. And I think we've seen that shift. And I don't see that shift changing. We have properties with, double-digit, significant double-digit change outs when a resident leaves and a new one comes in. They're paying typically is, at least, we have, well, a significant increase, as everybody knows. And I don't think you're going to see that change out keep increasing. I think we've set new market rents, and they're going to not keep going at double-digit paces, but the rest of the units will be catching up.
So Brandon, another area that we're following is the demographics of our resident base, in the sense that for example, I'm going to take a 3-bedroom. So a 3-bedroom you would think would house a family. And we're finding that the family has been replaced with roommates. So 3 roommates or 4 roommates in a 3-bedroom, where it would have typically been a family with 2 children. And in that, it does create different needs at the property, but also we are looking to see what is that next phase of household formations. So in the days, I've been doing this since the 80s. And so I remember what was always deemed the yuppies. The yuppies were like what everybody was building and trying to attract. And then they got married and bought houses and disappeared. So in this trend, we are watching to see how long does the roommate population become this resident base for us, or what's going to replace them. I think the traditional family's been priced out of the 3-bedroom market. So we're not thinking that they'll come back into that. But also if formations of households, how long will roommates stay roommates? It's all fun and games when you're young and maybe when you just get out of college, but at some point it gets old and they want to get back into having their own place. And so that'll be a question of whether they can afford it. And also, or do they have to stay in a roommate situation, or if they form some sort of household that then goes off and buys a home. We are watching that.
Yeah, absolutely.
I'm going to add to that. I think part of what's happening is over the years, we've had a fairly sizable shadow market of single family homes for rent. but I think the price appreciation and has allowed a lot of those owners that rented them out to sell those to homeowners now. So I think that's changed some of the 3-bedroom issues. But I think for next year, get back to your question about next year, the biggest risk that I would see that could happen next year is the Fed raising interest rates, and that would push up cap rates. That's, you know, and if the costs are still a problem and cap rates move up, that could stall the market.
Mm-hmm. Yeah, absolutely. You are 100% right there. We've been dealing with some steady rates here as of late, which has been fortunate. So
yeah, it's been great. Great. But you know, how long is that going to really continue? It's a tough one to know. I mean, we're going through a little bout of inflation now. Is it short term? Is it long term? That's the big debate. What does the Fed do about that? The Fed's just part of the world economy. All these other governments are still low rates. So, you know, nobody really knows. But I just say that's probably the risk. Yeah. But I don't think the risk is on supply and demand. I think we got one of the better economies in the country. We're still generating lots of jobs, fairly good incomes almost everywhere you go. So I don't think that's the problem. I think the problem is going to be cost and possibly cap rates.
Yeah, absolutely. Well, to finish things off here, I do want to go through a bit of a speed round. So just have a couple questions for you guys. If you want to keep the answers as precise as possible, I'll just go in the order of how I introduce you guys. So Kathy, then to Beau, then to Brian. So favorite submarket in South Puget Sound?
Oh, I have to admit, I do like the smaller towns and municipalities. That's my preference versus the larger. Mm-hmm. So I'm targeting in on those, particularly for neighborhoods with strong schools.
It's a tough question, but I'd say to answer it with like a quality of life, like what's kind of the most fun area to invest, I'd say probably the north end of Tacoma has a lot of culture and unique aspects to it that is always fun to look into.
Absolutely.
Yeah, I'd have to focus on Tacoma, number one, primarily because it's the UW's branch campus is an engine that isn't going to quit. That engine is going to keep going, and it's significant. If you got out of Tacoma, I'd probably like Puyallup, Bonnie Lake or Puyallup. Again, back to that woody walk up, 3-story, easy to do kind of product. But if you're looking for more urban and probably stronger growth, that'll be Tacoma. The only risk to Tacoma is supply. That's probably the one area that has the most concentration of supply.
Mm-hmm. And Kathy, you actually did touch on this. Next question, we're seeing a very common trend of mom and pop owners selling to private syndicators and institutional investors and getting out of the market. Do you see this trend continuing, or do you think there's going to be a return of the mom and pop family investor here in the future?
The difficulty is that part of it is just the makeup of a mom and pop. The makeup of a mom and pop is roll up your sleeves. It's hard work. It's save your money. They don't have new cars. They don't have fancy purses. They don't drink lattes. They work. And so that is kind of gone a little bit. Sometimes I think we see, which I've been encouraged though, is the younger generation stepping up and say, hey, I want to do this too. So that has been enjoyable to watch as they mature into being investors from their parents' properties or family properties. Yeah. It's not for everyone though. It's grueling. I mean, these are 7-day-a-week, 24-hour-a-day jobs. And so when you get the surprises, the 2 a.m. on a Saturday night or something, those things, they wear you out.
Yeah.
So on that side of it, I do think the mom and popper can just move to other areas. I mean, most of the ones that I've talked to have left, they're leaving the state or have left the state for other municipalities. They're frugal. So they're going to do an exchange and they're going to go to the Carolinas, or they're going to Arizona, they're going to go to Texas, they're going to go to Florida. That's what they're doing, is they're just moving out of the state in a way. I think the construction trade was an area that we used to see mom and pops come out of. And if the construction trade stays strong and they're generating enough income, we might continue to see some of those smaller, like a 20 unit to a contractor. We might continue to see that. We do have a lot of that supply. I mean, that's not going away. I mean, they're not going to, you don't see a lot of people demoing a 20 unit and putting up a 60 unit. So that supply will be there, but it's going to take a lot of cash to get into it.
Yeah. Beau, what do you think? Return to the mom and pop or continue to private and institutional?
Yeah, I mentioned the sophistication factor.
Yeah.
Especially on the larger deals. I think Kathy also mentioned the, just the sheer price of these things, and the escalation there is challenging for smaller entities. And Kathy, I think you bring up a really good point about the construction side of, the construction business producing more mom and pops that can operate in the maybe 20 to 40, 50 unit deals. I think, especially in the Pierce County area, people that were either fortunate or lucky or smart to have been developing over the last 3 years have made, a significant amount of money from that, compression in yields. So there's probably, a good chunk of, mom and pop builders that are going to be trying to operate, I think. But large scale, I'd say the sophistication is an issue. The moratorium was a big issue for smaller operators.
Yep, absolutely. Brian, any comment here?
I would add my observation for small builders was most of them were gone during the Great Recession that we went through. It really hammered the small, the folks that were building the 10 unit and the 15 unit. I hardly see them anymore. I know one or two that made it through. Most of them were gone. Some of them I know moved on to build custom homes or jump into the single family market, but it's been more and more dominated by the big guys and not the little guys.
Yeah. All right, we only got a couple more minutes here, but another question, super speed round. Kathy, what keeps you up at night?
Staffing. Finding good quality staff, and at the same time, I'm going to put staffing / vendors because I am concerned about, like Brian mentioned, we saw 50% of our vendors fold in the Great Recession, and now we're looking at a huge base of potentially retiring vendors, and these are subcontractors. So put the two of those together, and we're trying to educate and trying to train from all levels to be able to fill positions that we have available.
Absolutely.
Mine's probably more existential, but income inequality and its sharp rise. I think about a lot, and I think I'm very concerned about it. And I think it's going to make existing issues that we have as a society, worse and worse over the medium term. So it'd be great to figure out a way to reduce a bit of that.
For me, I have to agree with both Kathy and Beau. Kathy's point about staffing, everybody's concerned about that. I lost my office manager gal to an emergency medical thing, and then it changed her life. Took me 2.5 months to replace her, and I finally replaced her. It was kind of just by luck. So staffing is a real problem. There's no doubt about it. And Beau, I think you're right about the inequality thing. It's another way to look at it is the shrinking middle class, right? And it's the middle class that really drives the economy. And that's where I'm worried about that longer term.
Yep. And then just last question before we finish things off here. Once again, thank you three so much for joining the panel today. But what's one thing that you want the participants to know about your company?
Well, I just wanted to say that people keep calling up and wanting appraisals done in 2 weeks. So first I want to tell them, no, it's more like 5 weeks, folks.
Yeah. Feel that.
Yeah. I think for us, I think a lot of people know us as being, extremely active on the acquisitions front. But I think what the market probably doesn't know as well is that, Dave 𝐏𝐻𝐿 and Carrie Anderson founded our firm, and they have considered them kind of visionaries in real estate, and they have such a strong focus and philosophy on operations. And so while we're kind of more visible on the acquisition side, I'd say the core of our property is trying to be exceptional on property management and executing on business plans.
Absolutely. And Kathy, to finish it off.
Well, I think one of the things that's been fun for our business, because it is a lot of work, and that is that we get to put on different glasses. And so for me to go into like a North End 20 unit and look at that property and turn it around to my expectations and the client's expectations, or to go to a 300 unit and take on a bigger investment group, it's fun, and it does allow us to put on different glasses and enjoy our jobs better. And with that being said, I do think that the United States has the best housing in the world, and I strongly believe in that. And I just hope that the regulations and the consistent changing laws will just slow down a little bit, make some economic sense. Because I do find that most of these things have been to the detriment of the resident base more than anyone else. So educating and keeping on line with all these is really, really critical for this future part of any of our growth, all of us here today. So.
Yeah, absolutely. Well, once again, thank you three so much. We really did hear a lot of great ideas today. We're talking about predictions, trends, drivers, what we expect in 2022 as far as competition and deal flow, but also, some frustrations as well. So, participants, I hope this does give you some food for thought as we move into 2022. Thank you for taking some time and tuning in today. You can reach out to myself if you have any other questions for any of our panelists. Feel free to reach out to me. I'm happy to connect all of you. If you did tune in today, I will be giving you an individual call myself to make sure I'm answering any follow-up questions that you do have. We're all believers in the apartment market outside of Seattle. I'll end with a quick quote before I let you go from renowned real estate investor David Waronker: buy real estate in areas where the path exists, and buy more real estate where there is no path, you can create your own. Thank you so much. And once again, thank you to our three panelists as well, Kathy, Beau, and Brian. Have a good one and have a great holiday.
Thank you.